Okay, so I want to have this cash flow efficiency. What do I need to do actually to set this up for
Yeah,
myself?
in the system, in a framework, and I love frameworks because you can apply it in your life, regardless of where you are. Some folks might just beginning, maybe they bought their first laundromat. Some folks might have 5 or 10. Some folks might have 20. Some folks might have 50. So that's why I love frameworks. So the first framework is we all make our capital. We create capital in some way, shape, or form. So whether it be in the capacity of a W-2 employee, whether it be as a self-employed person, a business owner, or investor. And then we have to put it somewhere. We have to position capital somewhere. And then we have to deploy it. We either deploy it back into our businesses to generate more cash flow from businesses. We deploy it in the laundromats and real estate. And then, of course, we have to protect everything. And it's done through tax strategy, it's done through asset protection, and it's done through proper estate planning. So where infinite banking fits in, I'll get into exactly what it is and how we use it, and how people in our network use it. So where infinite banking fits in is where you position this capital. Now you can position capital in a number of assets where you can purchase an asset or position capital in an asset where you can utilize that asset then as collateral to establish a credit line. So you can purchase an asset that can generate cash flow, appreciate in value, and also provide great tax benefits, and you could use a little bit of leverage, but you don't have to sell that to extract capital from it. You could place it as collateral. And this is huge, of course, in the banking system. So, what I mean by that is if you're a real estate investor, you've heard of a HELOC, a home equity line of credit. So, when you want to tap into an equity of a house, you don't sell the house, you just get a HELOC, and now you have a credit line, a revolving credit line. You could do a cash out refi too. I understand that, but let's just use the HELOC as an example. You could do the same thing with a stock brokerage account, by the way. It's called asset-based lending. And fun fact, that is how Elon Musk came up with a down payment to buy Twitter, which is now X. He placed a lot of his Tesla shares as collateral. And I've talked about Elon's strategy for years now because he loves this. Why does he do that? Well, he doesn't have to, number one, sell his Tesla shares. And number two, there's no tax consequence. Because had he sold that, well, now there's taxes. He doesn't own it anymore. He places it at collateral and get a loan, a revolving credit line against that. You could do the same thing with gold, silver, and art. I've actually used gold and silver to establish a credit line. You could do the same thing with your business. If you have a business that has assets or equipment or receivables, you could place that as collateral to get a line of credit. What we use and utilize is life insurance, and very, very specifically designed life insurance policies. These are life insurance policies that are designed with living benefits. This is what the ultra wealthy do, family offices, centimillionaires, multimillionaires. This is what corporations do. So anyway, so you design life insurance not just that somebody benefits when somebody else kicks the bucket. You design it that it becomes a place where you warehouse capital. So we, for example, use a dividend-paying whole life insurance policy with a mutual insurance company. Mutual insurance companies are not listed on the stock exchanges. They are outside of the Wall Street casino, which is a very, very important because they manage the company on behalf of their policyholders. So they are their shareholders. So we use mutual insurance companies. We set up these insurance policies, which is designed, by the way, for cash value, for your savings. It does have a death benefit, but that's not the primary objective here. The primary objective is getting your money inside of these life insurance policies, and that's where you warehouse capital, not banks. Trust me, that should not be a place where you're warehousing large capital. At the time of recording and what we're seeing coming in the next 6 months, you definitely don't want to have large sums of money in banks. We've already seen 5 fail. 10 has already been downgraded by Moody's. 11's on a watch list. There's a lot of fun coming in the next couple of months. But let's just put that aside. The primary place where you warehouse your capital is these life insurance policies. Why? Well, the money in there is guaranteed. So the savings that you have in there is guaranteed. It never goes down in value. It's not tied to the stock market. You also have guaranteed growth. So the growth every single year, your policies are contractually guaranteed to grow. You also get dividends, which is kind of like quote unquote profit sharing, because you are a shareholder through a policyholder in the mutual insurance company. So when they're profitable, you get a dividend distribution. Some of these companies have been around since the mid 1800s, and they've been profitable every single year since the mid 1800s and pay dividends every single year. So you get to benefit from that. So you're earning about 3 to 4% in these policies, but it's tax free. The growth and the dividends are tax free. Now you have to obviously put up capital and take additional risk to get 8 to 9% out in the market pre-tax. So 3 to 4% you get tax free. And of course, the great thing about it is you can establish a line of credit, a life insurance line of credit, just like a HELOC, against the cash value. Usually it's up to 95% of the cash value that you have in the policy. There's some ways that you could do 100 too, that we've leveraged that in our network. But you set up a credit line, and then you can use that money to buy more laundromats, buy more equipment, and so forth. Now, why would I want to set up a credit line to access the cash? Well, number one, it's tax-free. You access the money tax-free. Number two, your money is now working in two different places simultaneously. So the money that's inside of this life insurance policy keeps on growing. It is uninterrupted compound growth. So because you never actually touch the cash value, you have a line of credit secured by the cash value. So if you have $100,000, let's just say, in this account, and you take a loan for $50,000 to go and buy equipment for one of your laundromats, you still have $100,000 in that account, earning uninterrupted compound growth. And then you get to use that 50 to go and buy equipment. And of course, you can structure it where you obviously get the tax benefit from the equipment too for your business. And maybe it is, you've added more machines, so there now is increased profit in your business. So there's a lot of ways to creatively do this. But that's kind of at the core of the strategy. So we generate capital, we position it in these insurance contracts because, number one, now it's in our own pool, our own little pool of money, our own pool of capital. It gets deployed in our business and investments, but it always comes back. And I'll give you one quick example that we've actually used with equipment in our network. And you could definitely do this with laundromats. So one of our clients at Producers Wealth, which is the insurance brokerage firm, which I founded about almost a decade ago. It's funny, time flies when you're having fun. We service clients in all 50 states in the United States. But one of our clients, so what he did was he set up the policies, and he set it up for his family. He took a policy loan from using a credit line, right? So he set up this line of credit. It's also called a policy loan. Took the capital. His money was still working in these contracts, earning 3 to 4% uninterrupted compound growth. So then what he did was he created a note to his business because he was lending his business the money. And his business then took the loan and went to go buy equipment. And because it was equipment, you got the depreciation and you get the tax benefits and so forth. And the business is now repaying the note to him at above the interest that he's getting on his that he's being charged on his credit line. Let's just say it was 5% on his credit line from the insurance company. He charged himself 10%, or his business 10%, which can be written off taxes too. So number one, there's so many ways you got to dissect this. Just think of in how many ways your money's working here for you in this one example. So in this one example, your money is in a life insurance policy that is growing uninterrupted, 3 to 4% compound interest, tax-free. Then you leverage it through a credit line. Lend the money to the business. It's a loan that has to be repaid. The business bought equipment, got a tax benefit from buying that equipment, and it's going to generate more money for that business. So there's some more capital at work there. The second piece is the business is repaying the loan to the person that lent them the money and paying them back at an interest rate. So they're paying 10%, each credit line was at 5% and it's simple interest. So there's a profit there too. So this is what I talk about efficiency. There's just so many ways here that and by the way, I forgot to also mention they can deduct those payments for the equipment, right? The loan and the interest. There's so many ways that your capital is working here. And it's one pool of capital that we're talking about. In this example, I just use let's just say it's $100,000 that was put to work. Just think how many things that one pool of $100,000 was doing for this client of ours. And that's what I talk about, efficiency. Could this client just have gotten a traditional loan or a line of credit at a bank and buy the equipment, pay the bank back and still make money in the business? Sure, of course. But now cash flow efficiency, he's the banker. His family's the banker. He has now created this pool of capital, which he will deploy into the marketplace. It'll all come back, and it's at the same time, this one pool of capital, this example, 100,000, is doing so many different jobs. I lost track of counting. I think it was like 3 or 4 or 5, right about there. Different things that it's doing simultaneously. And by the way, I didn't even throw that in. If something had to happen, there was a death benefit that kicks in for the client. From a family continuity standpoint and a business continuity standpoint, so I guess we could go on and on and on and on the many different things that this did for that specific client. But that's how you increase efficiency. That's now you're generating cash flow in your business, your laundromat, and your cash flow efficient, which frees up so many other things that you can do as well.